folks? Hope everyone's having a great trading week so far. We'll be going live in just about 3 minutes, 30 seconds here. So to Back to the Future should be a lot of fun. Got a lot of ground to cover and what's going on in these markets. Seeing a lot of pressure in Bitcoin overnight as well. We'll talk a bit about that. Stay tuned. Also, just noticed on the calendar, we've got Trump speaking at 9 a.m. along with the Fed's Schiller data coming in at the same time. Folks, we are going live here with this week's episode of Back to the Futures with me, Markets and Mayhem. Excited to be here. Got a lot of ground to cover, so let's get right to it. First and always, manage your risk, please. I want to see you next week, the week after, months and years in advance. I just want to keep seeing familiar faces, and to me, that means you haven't blown up your account. It means you're continuing to trade, you're treating it like a business, you're managing your risk accordingly. There's really nothing more important in the game of trading than managing your risk. Because if you're not doing that, you're not going to last and the rest won't matter. So this is why we put out this disclaimer, but it's also why I give this little pep talk, because you don't want to learn about this fortune right here. That's the portfolio gone. That happens if you don't manage your risk. And the reason it happens is because it's really hard to recover from big losses. The bigger your losses get, the less likely it is you'll ever be able to recover your capital. And if you get on a tilt, you start revenge trading, you're just going to get more. So I'm on how much am I willing to lose on this position, such that it won't keep me up at night, that I won't go full tilt, start moving stops deeper into losses, that I'll actually just handle this position systematically without it eroding my ability to control impulses or emotions. Find the sweet spot. For me, it's a position where the stop is set such that I'm not losing more than 1 or 2% of the portfolio's liquidity on a single trade. That affords me plenty of additional opportunities. So if something doesn't work out, it's no big deal. I think that's one of the most important parts of figuring out how these markets can work for you. A lot of people don't succeed in trading because they try to take shortcuts, because they think it's easy, because, there's this idea of lottos and Lambos. And so folks just focus on the destination. The reality is successful traders focus on the process. The destination is something out there in the future, but you can't even think about that much until you get your process down, until you become consistent. How do you become consistent at trading? Well, first, you have to figure out where your strengths are. You have to lean into those. And the best way to do that is to journal your trades. Journal every single trade you're making. Why are you taking that trade? Are you using a position that you're building over time? Like you're averaging into that position, say 2 or 3 lots, or are you actually just going in all at once and thinking, I've got it, I know exactly where the market's going to bottom, and I'm just going to run this move higher? If you're going all in at once, often is the case, you're not giving yourself a chance to let volatility work in your favor. That's true in both day trading and swing trading. It's also true in investing. It's usually better to take multiple entries to build a position. Can also help to reduce some of that impulsivity, like I'm smarter than the market. Now, that's not to say everyone needs to trade the same way. I don't believe that's the case, but what I do believe is from a statistical perspective, systematic trading, that approach has a much higher likelihood of success than discretionary or basically gut feel trading. Gut feel trading has more of an emotional attachment to the market. It's more like gambling. There's this big dopamine rush. It can be fun, but should trading be fun? That's something you're going to want to ask yourself. I think it should be boring, personally. So a bit about me. I've been trading for 21 years. And yeah, at first it was real fun. It was a lot of fly by the seat of my pants, leverage trading in, stocks and futures. And I made some money, I lost some money, I made some money, and I lost some money, and I made some money. And I didn't really figure out that consistency bit of it until I was navigating through the great financial crisis and really learning what it looked like when markets come unglued. Risk management, well, that was either survival or death at that point. Not that it's not survival or death now, but it could literally be survival or death in a single session, if not a 5-minute period back then. I mean, you had some of the most wild swings I've ever seen in my life, and not just to the downside, but to the upside too. One of the things about bear markets that, doesn't really get discussed a lot because we haven't really seen many over the last, 20 years, is that they have some of the most violent rallies you've ever seen in your life. I mean, you think going into a bear market, okay, I just short and everything's fine. No, you can see days where the S&P is up 5, 6, 7, 8%. You can see days where single stocks are up 30, 40, 50%. So you've got to be careful managing your risk in both directions in all of those environments, but especially when volatility is picking up. So the other thing that I wanted to discuss outside of just focus on your risk management, your consistency, and your journaling is to look at sizing positions based on their volatility. If a position is more volatile, it should enjoy a smaller size in your portfolio. If a position is less volatile, it should enjoy a larger size. And that inherent volatility should help us determine where our stops should be placed. That way, we can make sure we're not losing more than 1 or 2% by the way we size that position, calculate its volatility, and place our stop or our risk management. This kind of math makes it a lot easier to run your trading like a business. You're taking calculated risks, you're buying and selling inventory, and you're hoping to capture the spread repeatedly. You're not going to win every trade. So another thing that's really, really, really important, be willing to let go of those losers. Don't worry about the ego hit. It doesn't matter. And the more of those that you take over time, like if you're trading for years and you've got like a 60% win rate, 40% of your trades are going to be losers. Learn how to let go quickly. When a loser exceeds its risk threshold, it's gone. It's in the rearview mirror. You're not looking back. You're not revenge trading. You're focusing forward on the next opportunity. And because you're cutting your losers quickly, there's no emotional pain because they're right sized as a portion of your portfolio. So you're not taking more than 1 or 2% of portfolio liquidity as a hit. That means you have enough capital to keep that business open. That's a really important part of trading, by the way. You've got to treat it like a business and you've got to have the capital to keep it open. Next week, next month, next year. And it really is a business, by the way, and it really is buying and selling inventory. Don't dress it up into something it's not. It's not Lottos and Lambos. You know, it may be some folks come to trading because they think it's easy money. I can tell you right now, the people that get luckier are the people that get hurt. Like if you got a really big first trade, let's say you made like a 5x on your portfolio and you think, okay, I've got the Midas touch and I'm absolutely God. And it was some sort of degenerate options trade with leverage, right? The next trade or two that you take are probably going to hurt because now the risk management mentality is gone because you're like, oh, I can just touch anything and it goes up. But it may have just been luck. It may have not been, suddenly becoming a trading savant overnight. And so I find actually it's really difficult for the folks that get lucky when they're trading to right size their risk management over time, right? It takes a little bit more lessons to realize actually that was luck. You don't have the golden touch. And, once you start kind of going through those losses after the luck runs out, it becomes more and more obvious. That's another thing that I think is really important for us to appreciate as traders, by the way, that there is a lot more about your approach, your attention to detail, your ability to execute even in times of great pressure than it has anything to do with luck, than it has anything to do with any other kinds of things. I see folks that look at like astrology and moon charts and all sorts of stuff. Believe me, that has really no impact. Trade the market in front of you. Don't have a deep bias. Be willing to change your mind if you're wrong. It's not bad to be wrong. It's just you can't stay wrong for long. You got to learn from being wrong. And so we talk about taking a more strategic, systematic approach to trading. I think that's the end goal for everyone, to become a more disciplined, systematic trader, to be able to take emotion out of the game so it's not so taxing, so you don't close out your trading day feeling exhausted. Where did my energy go? Because a lot of it also comes down to just staring at charts all day. What if you set up alerts for different types of outcomes, like a crazy reversal in flow or hitting a certain level or breaking above a key indicator? That can also save time. And that time is also mental capital, which we need to preserve. So just consider the ways you can optimize your trading. Consider what approaches you may be able to take to extract better outcomes, because you're putting your time in. You're putting your capital at risk. And I'm not one of these sim guys. I don't trade other people's money in these other accounts, these sort of modern day bucket shops. If that's what you all are into, that's fine. Just make sure you get paid and you don't play around with some of the players out there that are not very ethically sound. There's a lot of bucket shops that, I mean, basically you got to understand the whole idea of these sims, of these prop firms, is that most people blow up and that they have to, keep buying new sim accounts and basically just keep feeding the beast. And a very small percentage get payouts. And that's not enough to turn the business upside down. Because if more people get payouts than the business is able to pay out, they're done. So the whole idea of prop firms is essentially to make sure most people lose. And only about 4% of people that engage a prop firm ever get a payment, ever. That's not that 4% are consistently getting payments. It's that only 4% of those traders ever get a payout. So the odds are not on your side in that stuff. I prefer trading my own capital. I think it's much easier to really align yourself with your risk management, become more disciplined. You also don't have a lot of artificial rules that these prop firms add in that aren't really realistic for being able to have repeatable trading success. So, that's just my rant. Again, it doesn't mean that it's like no one can trade with a prop firm and be successful. That's not what I'm saying. I'm saying the odds are very low. Now, granted, in trading, only about 1 or 2% of people actually become successful. But that's a lot different than only 4% of people getting a payout from a prop firm. If you think of 1 or 2% of people being successful over years, that means that a lot of people in that group made money, but over time, many of them eventually crashed out. So that's still a more favorable statistic, trading your own money, than trading a prop firm that adds more rules, more complexity, less chance of getting your money. That's my rant about that. I want people to be careful. That's all. Now, we talked a little bit about strategy. I think that every strategy looks awesome on paper, but it's not until you actually are trading it that you can realize its strengths, its weaknesses. So this is one of those things that I really like to go back to and say, look, if you're not journaling your trades, you're not really going to know if your strategy works. And if you're not determining whether your strategy works, then you could look like the guy in that lower pane here, nailing a board in his head every day, trading his quote strategy unquote, but it's not actually a strategy because it's not really tested, because it's not really iteratively improved. This is the idea, the utility of a trading journal, because every week you can review and say, okay, how did my strategy do? What worked, what didn't, what instruments, what trade setups work with my personality, what don't. This is a review to figure out how you can become more consistent and disciplined. It's a review to also determine whether your strategy looks like this. Because if it does, you can improve it, you can switch it up. Just don't do that while you're in the trade. Because once you start throwing out rules while you're in the trade, discipline becomes more and more tenuous. So let's look at some charts here. First, my goodness, the rotation out of Bitcoin and into gold is intensifying. I talked about this being a potential scenario last year in October, saying, what if instead of going from gold to Bitcoin, as many were discussing last year, instead, we see an intensification of people going from Bitcoin to gold. And we've seen that play out. I believe there's a number of different catalysts for that happening. One of which is liquidity is really scarce. Bitcoin loves liquidity. It is a relief valve for excess speculative liquidity in the market. And so when there's not enough liquidity, Bitcoin tends to roll over. So I think that's something that we need to just take into consideration with everything that's going on right now in the market. That there's not a lot of liquidity in the reverse repo market. There's not a lot of liquidity in bank reserves. There's not a lot of excess speculative liquidity go out there on the margins and buy things like Bitcoin or Ether or Solana, etc. That's one of the reasons these things are rolling over. Also, if you're in a leveraged portfolio and your growth stocks are going against you and your speculative ultra growth stocks are going against you, the ones that are pre-profit, you might look for parts of your portfolio to be able to sell down so you don't have to take down some of those other core positions. One of the easiest things to sell during a time of raising cash is something like Bitcoin, because you look at your portfolio, you say, okay, well, this company, maybe it's worth X. What is Bitcoin worth? If you can't answer that, you're going to sell it, and no one can answer it really, not intellectually, honestly. So I think that's also part of the issue. Is some of these more crowded trades, the AI growth narrative, the quantum stocks, the neo clouds, all this sort of stuff has become much, much more under investor scrutiny. And you have portfolios where there's some degree of commingling between crypto and speculative stocks and so forth. So I feel like the rundown in a lot of those stocks is also hurting crypto. The lack of liquidity is also hurting some of those more speculative stocks. So on the other hand, gold loves this environment. You have uncertainty everywhere. And if you see the uncertainty levels start to wane, they come back really quickly. Look at what happened recently with the escalation of tensions with Iran. We've got a military presence in the Middle East. There's some potential that this could turn kinetic. That's an issue also with the tariffs, the Supreme Court striking down the previous iteration of the tariffs, Trump and his administration figuring out new ways to impose different tariffs. All of this creates more uncertainty. Whether we agree with what's going on or not doesn't really matter. What we have to objectively assess is uncertainty is going up, and gold loves uncertainty. It is actually a hedge against uncertainty. And so I think that's one of the reasons that it's had such a powerful run. And then add to it really high aggressive deficit spending. That's the debasement trade. That's one of the core drivers. So I still think gold has room to run. I still think Bitcoin can also roll over further from here. And that's been something I've been covering pretty intensely because we're at a key area. If Bitcoin loses 60K, we're going down pretty heavily. So we'll talk about that in some of the technical charts, but I want to get to the next chart here. This is one that shows the overall exposure of hedge funds that are looking at momentum. So they are very, very, very long momentum in the hedge fund space. This is one of the areas I was talking about being a crowded trade. This is some of those growth stocks. It's also some of those high beta cyclicals. This is a very crowded trade. It's actually more crowded than it was in early 2021. And we know what happened to momentum after early 2021. That whole trade rolled over. The space saw a lot of stress. I'm not saying that the exact same outcome is going to happen here, but it's worth noting that this is an extremely crowded trade. We also have tech near a record percentage of the US market, just recently tagging that level. This concerns me a little bit because the narrative around generative AI is becoming more shaky. So when you consider that in combination, that you've got basically close to 40% of the US market as tech, and one of the biggest narratives that was driving tech re-ratings to higher and higher prices is under scrutiny, that's something we have to pay attention to. That's one of the reasons that stocks have been dropping. There's this defensive rotation that's been going on really since November. It's been out of some of the leadership stocks, the mega caps, some of the software stocks as well. And it's been into more defensive stocks. There has been a bid for semis, although I'd argue that now we've seen them kind of priced to perfection. And if anything happens to AI CapEx plans, that trade could become a little bit crowded at the exits. In fact, Goldman put out a note about that, saying it's probably a good time to hedge out some of that semiconductor position. I would agree. And if we look at this next chart, this is one reason why. About 89% of the S&P 500 semiconductor index is above its 200-day moving average. That's stretched. That is typically a situation where you're seeing some degree of exhaustion on the buy side. So I think we have crowded positioning in semis. You could see it in hedge funds. It's one of their favorites. They're absolutely mega long. You could see that the overall momentum indicators are starting to get a bit stretched, and the valuations are as well. So that's an area that's a bit crowded. I wouldn't want to necessarily get too heavily long into that area, at least until we see what NVIDIA has to say tomorrow when they release their earnings. Perhaps the most important earnings print in human history. It is every time around, by the way. On the other side of the ledger, consumer staples look really attractive to me. First, this ETF, XLP, is up 14% year to date. This is something we talked about the end of last year. Defensives looking increasingly attractive, looking for better valuations. XLP, the consumer staples ETF, looking like one of those better valuations, but it's also a very crowded short, which is interesting. You know, you've got folks that want to lever up their longs. They go really, really long these AI growth narrative stocks, these tech stocks, and then they go short other parts of the market, including things like consumer staples. Those are hedge funds doing that type of activity. And so on the other side of it, while there's this rotation in defensive stocks from more traditional money managers, there's also some degree of short covering from hedge funds that are on the wrong side of an explosive trade. The Nasdaq's down 4% year to date. That's where a lot of hedge funds are heavy. And consumer staples are up 14%. And that's where you can see there's a fair amount of shorts. So that's bleeding them on both sides of the book. That's what causes what we call degrossing, or basically deleveraging your longs and your shorts. And that deleveraging of shorts has been something that has had a powerful impact on price discovery this year. As we can see, the most concentrated shorts up 9% year to date, leading. That's actually pretty incredible to me. And I think that does suggest that this could be a year where you do see more shorts continue to perform in some of these really concentrated trades. So I did put out a note yesterday on Twitter sharing some of the most concentrated shorts in the large caps and in the small caps, and where shorts were building. So that's an area I think there'll be some very short-term trades. Remember, short squeezes are trades you've got to handle very carefully. Small position size and a short period of exposure is ideal of trading them at all. But I do think there's still some room in this squeeze that is developing. And then we have CapEx. CapEx continues to surge. In fact, we're seeing a 60% surge this year from last year's CapEx, and then another 20% surge for CapEx the year after that for 2027. I think that's a bit extreme. I think we're starting to see some signs that investors are becoming less patient with the lack of return on investment and becoming more concerned about how we're seeing a rotation out of something that investors had previously enjoyed. And that is, buybacks are falling this year, starting last quarter of last year, as it turns out, and CapEx is growing significantly. This is a trend that's continuing. That's removing one of the most important structural drivers of demand for some of these AI CapEx growth narrative stocks. So seeing this push into more CapEx and pulling away from share buybacks is likely to be a concern for a lot of these mega cap stocks that are very aggressive with their buybacks. Also, just on the whole, AI is ready to take over the world narrative that seems to be circulating again. I'd just like to remind people with a more sober take, we're nowhere close to that point. We are nowhere close to that point. Generative AI as it exists right now is a probability engine that is based on inferring relationships between data. It uses multiplication matrices to weight these data inside what is called a model. This is a situation where hallucination can happen, so it can return an answer that's completely untrue, or where catastrophic problems can occur, as seen on this headline. To say that AI is in the pole position to, in a year or two, to take all of our jobs or to replace entire industries, people are drinking too much of the Kool-Aid. And I say this as someone who's an avid AI user, but I recognize it's a force multiplier in its current form. You have to put guardrails on it, as Amazon apparently didn't, and you have to make sure you understand how it works so you can extract value. It is not artificially intelligent. It is really much more about inferring relationships, looking at what you've entered in as the data and outputting something related to it. It can certainly seem intelligent, and it can put out answers that are helpful and constructive. It can write code, it can create images and movies, but the dystopian narrative that it's going to take everyone's jobs and that the world will never be the same, that's more of a 5+ years out story than a next year story. So I think it is time to maybe take a more realistic, nuanced approach to how this is changing. It's not until we get the next generation of AI, whether it's self-learning models or something else completely, where there's a much larger scale of data and awareness and much less about probabilities and good enough answers, that we can say we have something that might replace humans at a greater scale. We're not there yet, might be a bit. On the other side of the trade, also looking at manufacturing, there is a boom that could be about to happen in ISM manufacturing. We could see a reading well above 50 in future reports. This would be good for the US economy, would be good for employment trends, it would be good for some of the companies in the space, these industrials, materials, some of the metals and mining stocks. It may not be good for the interest rate cut outlook from the Fed. You start to see the economy recover, you could start to see the Fed pull back on any ideas of rate cuts during this cycle until it weakens again. And as mentioned earlier, NVIDIA earnings coming out tomorrow after the close. I will be covering these live, so definitely join. We'll talk about the release. We'll cover the conference call live, complete with price action. Should be a lot of fun. We have a lot of earnings coming in this week, but all eyes on NVIDIA. It's easily the most important report. Now, we've got just about 2.5 minutes before the market open. Let's cover some technicals and momentum. First, we've got the S&P 500. It does appear more vulnerable. This is a distributive pattern. You can see it. I just decided to draw this half circle above to show what I mean. We're just starting to grind lower, and it's looking heavier and heavier. I do think if we crack the lower end of this range, particularly on a weekly close, it's likely we get down to the November lows around 65.25. That's the March contract November lows, but I think there's a pretty decent chance, and that's not a bad thing. I favor making a shopping list, looking for some of the beneficiaries of this rotation, looking for areas where, if there is a manufacturing boom, companies could benefit. I still think there's a lot of great names out there in materials, industrials, metals, and mining that could still have legs from here. But at the end of the day, the risk in the broader market is intensifying because the leadership is rolling over. And you can even have times where the indices are rolling over and other parts of the market are trading sideways to up. That's relative strength. And you want to look for that when there's these rotations, because that's where the money's going. Then we've got the NASDAQ, which also looks vulnerable to further decline. Chopping in a range. Its leadership stocks are also challenged. It never made a new all-time high in February. It certainly tried in January and February, but it never was able to, just rolling down lower and lower. Microsoft getting hit, Amazon getting hit, Google taking a hit, Tesla taking a hit. I mean, there's a lot of things going on that are upending the presumptions about when AI is going to generate bottom line growth, a return on investment for these aggressive spenders. And then also on the other side of it, what's happening to software, and is AI really as disruptive to this space as is being presumed? I don't think it is, especially for the companies that have stickier ecology or high switching costs. But I do think that we're seeing a change that will take place again over longer time horizons. Like yesterday, Anthropic came out with a COBOL tool and IBM crashed 12%, and IBM is clocking in its worst month in 34 years. IBM has its own problems. Anyone could have put that pin in and sort of popped the IBM balloon. That is to say, this is a company that's been mismanaged across multiple CEOs. The headline of Anthropic creating a tool for COBOL is just adding to an investor anxiety that had already existed, but I don't think it alone was the primary catalyst, because COBOL is not the core of IBM's business. But it shows you where we are in this market. People are very willing to sell whatever it is that's on the wrong side of the narrative. We also have gold. Its uptrend remains intact. It's challenging the upper end of this channel. I think it may try to break above and build above the channel on that next move higher. That's certainly what it looks like it wants to do. It's going to maybe challenge the channel top a bit and then try to make a push higher. But we've got to keep an eye on the dollar. I'll get to that chart in just a moment as well. Silver is also starting to look more constructive here as it breaks out of a wedge, starting to make a push higher. We could see some continuation here, especially now that China is back from its New Year's holiday. This is good for precious metals, as a lot of the appetite is coming from Asia. Bitcoin is looking really heavy. I think it could roll down to about 52,787 on this next move lower. This is the same chart I shared last week. It's even more conviction on my end because we're seeing that pattern break down further. And unfortunately, I just don't think crypto recovers until liquidity comes back, and that could be a bit. And I talked about the dollar. This is the chart we should be watching on the US dollar. It is still at this mega trend line going back to 2008, and it's not cracking. And unless and until it does, I think we still need to be careful with some of these overseas trades in the international markets, in precious metals as well. Because if you do get a big rise in the dollar from here, if you get some kind of bump up versus the euro, especially, that tends to be problematic to some degree for precious metals, and especially for markets overseas if you're not hedging out your currency exposure. These are this week's pivots. We're about to go to the live market. I realize the bell did ring, but we got a lot to cover, so I want to get through that. I'm going to share this out there on Twitter as well, so you can take a screenshot here or check it out there. And then really quickly, here are the S&P 500 key options levels to watch as well. And you'll note we've been playing around with negative gamma for some time. We are in negative gamma today. What that means is that you're in an environment where you're going to see more follow through on sells and more follow through on buys because dealer hedging patterns change to more of a chase dynamic. And for folks that are discouraged, I know it's been a rough and tumble ride for folks, especially that are heavy tech and crypto. It won't last forever. You've got to be patient. You've got to be resilient. You've got to keep dry powder on the sidelines to be able to deploy when the selling is done. Speaking of selling, we've got some great deals. If you want to check out Traderade, you can do so. Visit wap.com/Traderade. Use the code Mayhem20 at checkout. You can also get up to 40% off Bookmap. Visit Traderade.com/bookmap and scroll down to the special offers. Now let's go right into Bookmap here on screen. We've got the NASDAQ trading right off the open. We're seeing an aggressive sell, taking us down about 100 points on the NASDAQ. And inside the heat map, Broadcom leading us lower. Palantir getting a sell. NVIDIA selling off a bit here. AMD letting go some of its pre-market gains, now up just about 6%, was up over 8% earlier on a partnership announcement with Meta. I don't know where Meta is going to get all this capital. They say they're going to spend with NVIDIA, with AMD, and elsewhere. Eventually, I feel like their investors are going to get a little bit more impatient as well. I mean, the company is a cash machine, but they're also putting a lot of that cash into endeavors that aren't necessarily providing a strong ROI. So will be interesting. Oracle's been under a lot of pressure too. This company has had its worst decline ever as we see CapEx concerns growing and Oracle debt under increasing stress with these credit default swaps pricing in a higher likelihood of stress in Oracle debt as well. So Stephen asks for my view on Apple. Happy to provide that. I think that Apple is an interesting stock. I mean, on the one hand, I'm going to be completely transparent and say that I don't think the company has done enough to innovate in a long time. like a long, long time. It's kind of a chronic issue at Apple. On the other hand, however, it's hard not to look at their lack of AI spend and say, well, at least that, at least near term, may be smart because the scrutiny that the other techs are undergoing as a result of that same spend. I mean, if you're not one of the pick and shovel sellers like Nvidia or AMD or Micron, et cetera, you're buying from them. And those same companies are undergoing some stress now because people are starting to question, well, does this make sense? Should we be spending all this money on this build out? What if AI technology changes and becomes more efficient or uses a different type of compute? Um, Apple's not really grappling with that issue. The company, I think, could stand to take some more risks in other areas where it could try to build a competitive advantage. We haven't seen a lot of innovation in their phones. I will say I'm very impressed with their computer processors, though. The M4 and the M5 that's coming out later, they look really, really, really good. So that is an area where Apple's definitely innovated. So I'm kind of lukewarm on Apple. I like that they have lower AI growth capex risk, but I'm not a super thrilled by the fact that their leading innovation is financial engineering. They're the company that buys back more of their shares than any other. So kind of a mixed bag on Apple, but you can't argue with the performance. I mean, the share buybacks have been constructive. They've also helped to make the earnings metrics look better than perhaps they really are, because when you buy back shares, you decrease the float. That shrinks the PE. It makes EPS per share, or earnings per share look better. So, a bit of a mixed bag overall, but the performance for Apple versus the other mega caps this year has been night and day. So I think that investors are at least voting and saying, you know what, we're not too concerned with this company compared to, say, Microsoft or Meta or some of the others in the space that are undergoing some stress here. I mean, the difference between how some of these other companies have traded and Apple kind of gives you that sense. So Apple's like the defensive mega cap tech, if that makes sense. I think though what Apple is doing right now is smart. What they're doing is they're basically trying to buy some of the smaller, scrappier AI startups that they feel have but integrative potential with their platform. So if they're able to go down that path and save themselves the heartburn of trying to spend all this money and get limited results, and are instead able to find companies that can integrate. I mean, M&A in tech is really complicated and a lot of M&A fails, but if they can find companies that integrate well with their ecosystem, that could be a good accelerator for them and a smarter way to deploy their capital. Someday they'll fix Siri too. In fact, I think that's what the whole partnership with Google is going to be about, is basically putting Gemini on Apple phones, which is, I mean, that's so interesting that basically you just have this out in the open phone duopoly like that. But that's where we are. NASDAQ bouncing nicely off its lows. And I got a question. Can I show the ES bookmap chart? I sure can. Wow, that was a pretty chunky iceberg buy right there in that move. 1,300 on the buy side as we're challenging the point of control from below. Getting pretty close to VWAP here. That has confluence with key 2 negative. That's likely to be the next area of resistance to watch overhead. And remember, this is likely to be a more volatile tape because we are in negative gamma here. We're post OPEX, so we're unclenched from a lot of that gamma exposure. So you've got to expect this to be a more dynamic tape, at least up until 11 a.m. And then it seems like everyone just goes home and the market drops sideways for a few hours. It's been a trend for a bit now. Yeah, I tend to follow in Forex. Steven's asking what Forex pairs do I follow. So I tend to follow Euro USD. I mean, that's pretty much what the US dollar index is anyway. It's like mostly Euro weighted. I tend to follow the yen, the pound, the loonie. I like to look at the Aussie. Those are probably my primary basket that I'm looking at. And it depends. I mean, there'll be times where I'll do stuff that's more exotic. There was a time when I was trading the Swiss franc against the Great British Pound Sterling, just because there was this really, really big coiling up that took place, and eventually it resolved to a bigger directional move. So I'll trade some of the more exotic stuff as well when there's the setup. For me, it's just all about trying to find where my systems indicate there's likely to be a continuation of momentum. The direction doesn't matter as much as that there is momentum. I really tend to be more of a momentum trader than a mean reversion trader. So, it could be almost anything. I mean, there was I think it was like, what, 2 years ago, I was trading a bit of cocoa. Year before that, I was trading a bunch of grains. Like wherever the momentum exists, I'll trade it as long as there's enough liquidity in the instrument and as long as I feel comfortable in the way I can manage risk. And I do tend to prefer things that trade. Like, for example, I would rather trade S&P futures than SPY. I mean, there's the tax advantage, the 60/40 treatment, the lack of wash sale restrictions, but there's also the fact that you can manage your risk basically 23 hours a day, which, they'll say, hey, we're going to have SPY overnight, after hours, whatever trading on various platforms. It's not very liquid, so it's much harder to manage your risk in that versus futures. So futures and also Forex tend to trade like that. Whether it's direct pairs or trading futures on Forex, you're going to have like 23/5 access. I like that a lot more for trading because one of the things I don't want to do is go to bed and not know if my portfolio is going to be there in the morning. And obviously risk management, position sizing, all that makes a big difference. But the other part of it is making sure that if you need to manage your risk overnight, that you can automatically have a stop trigger. And there's a lot of instruments you can't do that in. And they often are also the ones that tend to have the biggest gaps, things like single stocks. Doesn't mean I won't trade those single stocks, but I definitely have a much more contained risk management system for those if they're not going in the old investment portfolio, if they're actually swing trades. I'm going to be using either option strategies like spreads or smaller position sizing. Nice recovery, by the way. We are pushing above that point of control. We saw that big iceberg absorb some of those sellers. That led to some reinvigoration by buyers here. We're coming up to this large area of offered liquidity around 68.75 with 464 contracts on offer. A good test of the buyers will be, can we get up there? Can we absorb that and keep pushing? That gives you an immediate sense that the demand is strong, as suggested by these large green delta bubbles. If we get up there and we kind of look at it and reject hard, that's going to give you a sense that buyers, in fact, do not have the demand, and that might be an early reversal. Yeah, if you guys are enjoying the stream, hit like, subscribe, share it out with your friends. Doing this every Tuesday at 9 a.m. Been a long-time partner with Bookmap. Great company to work with. Solid product for intraday trading. And that's why I do these streams, because I use the software myself. I find a lot of utility in it. And I want to share with other people how it works. So, Stephen, to your point about currencies, I just want to quickly bring up a chart because I feel like this is a fun one to continue visiting, and this is for everyone else out there to enjoy as well. I'm gonna see if I can put this on screen. All right, so this is a chart of the US dollar index going back quite a ways. Let me see if I can actually show just how far a ways it's going back. Got to just resize my screen a little bit here. There we go. Going all the way back to 2008. So this is the mega trend line for the dollar. And so I actually think the currency trade right now is very contrarian. Everyone hates the dollar. I mean, hates it. Euro longs are crowded, dollar shorts are crowded. Obviously, the gold and silver trade was a bit crowded, shaken out a little bit. Gold's still pretty crowded overall. But the dollar hate trade is super crowded. I think the contrarian trade of what could be a decent little return in Forex land is going to be longing the dollar here and maybe targeting about 104, 105. Not the biggest trade ever, but it would surprise a lot of people. And if this thing actually gets a bounce off this, decade plus trend line, it will shake out a lot of that short positioning. So my contrarian Forex trade is long the US dollar index short term using this trend line to manage risk, which goes back to 2008. Let me know what you think about that one, Stephen. And that recovery continuing, we got right above that 68.75 offered liquidity level. And you can see buyers are not even looking back. So this is a very good sign. If you subscribe to auction theory like I do, that suggests demand remains strong here. And they are continuing to absorb overhead liquidity. The gamma flip level that we have overhead has often acted as an area of resistance, a reaction zone. And then just above that, we have a very powerful magnet at gamma 1. So we may get all the way up to the flip there and kind of get stuck. It's going to be very important to see how price reacts because the last several times we've tested this flip level, we've rejected lower. And you know what? Let's quickly check in on our friend Bitcoin, see if it's still alive over there. Oh, it's recovering off the lows. This is good. This thing had a brutal night. I mean, let's just look at the last day. We'll backfill that data if we can. It just look at that. Absolutely smashed. Lower highs, lower lows, lower highs, lower lows. Starting to look like maybe it's trying to build a base here, but I wouldn't get too excited yet. And I'm going to go back to sharing some views on Bitcoin a little bit later about where I think this could be going. But again, 52,787 seems like the path of least resistance, especially if we break below 60,000. Slumming Secrets, the best way to learn how to trade with Bookmap is come hang out. They've got a great Discord. They've got all kinds of educational resources. I'm there once a week, Tuesday at 9. Bruce is there. There's other educators. There's all kinds of great content on their YouTube as well. So if you really want to gain the benefit of using Bookmap, I would recommend checking out their Discord and their YouTube. Their website also has a lot of great content as well. And this just in, Anthropic is expanding Claude's capabilities with new plugins for Microsoft. So does that mean Microsoft is going to zero today? Probably not, but you never know with this market. So I'm just going to put that out on the feed. That was a very aggressive move higher, by the way. We'll see if we're able to hold it, but yeah, it was quite aggressive. Yeah, Steve's out there providing all the great links to slimming secrets about how to get on board and learn more about this platform. I will say that for me as a trader, education has always been really important, both for my own purposes to try to learn more and also to try to help others. So that's another reason that I do enjoy Bookmap is they really are all about education. It's really important to me. It's really important to them. I like that. Investor MM, good morning. Yeah, if you could just actually go over to the Bookmap YouTube channel, Steve just dropped a bunch of great links in there. But basically, in a nutshell, check out their Discord, check out their YouTube, and check out their website for links. They've got a learning center as well. But if you go visit the Bookmap YouTube, you could check out those links that Steven dropped in there. He's under the demo trader 7570. Yeah, and also like making sure you get smart use out of screen time. So, you don't want to just spend all day in front of the screen watching. You've got to try to focus so that your mind is ready to learn. Like watching how the market opens, probably going to be more helpful than watching like lunch hour. If you optimize what windows of time, just like the market close. In fact, if there was only 2 hours a day, you could watch the market 9:30 to 10:30 and 3 to 4 would be the two that I would focus on the most, just because you really see how these large order flows can move price. And Investor MM, I'm doing these every week, Tuesday at 9 a.m. So I do talk more about Bookmap in the stream as we go live about how to use it. But we're running a little short on time today. But I'd be happy to cover that more next week if you have specific questions for me as well. Now we have U.S. Conference Board Consumer Confidence coming out at the top of the hour. Forecast 87.1, prior reading 84.5. We also have U.S. wholesale inventories month over month revised with a forecast of 0.2% and the same prior. Moving out further into the day, Trump speaks at 12:30. ECB's President Lagarde speaks at 12:45. That could be a currency moving event. And then we have the 2-year note auction at 1 p.m. Finally, Feds Barkin and Collins speak at 3:15 p.m. So we are seeing a little bit of a rollover from that aggressive move higher. We did get into a zone of more heavily offered liquidity and are rejecting lower from there. That does suggest that buyers are running out of demand. On the other side of it, sellers are starting to get into some areas of offered liquidity on the bid. The same theory applies in reverse. That is to say, if they're able to push through below and keep going, that suggests they've got plenty of supply and they could keep pushing. And we do have some flows coming in today. The most active strike, the hot put, is in demand, as is the second most active strike, the warm put. This is suggesting that there are both some hedging flows coming in ahead of NVIDIA's earnings tomorrow. as well as more concern about downside risk overall in this market. So it's not quite 2 to 1, but it is strong enough on that downside flow that it could start to pull the market even lower. We also have a confluence area between the vol trigger and the put wall just around SPX 6800. That should provide some support below the point of control. And we can see now we have confluence between gamma 3, the VWAP, this white horizontal line, and the point of control. So this is a pretty big line in the sand. The market is generating that information to show us we need to be watching this level. It's going to be a decision zone. I'd say intraday, that's our pivot to be bullish above, bearish below. Meta is looking to enter the stable coin space later this year. Company had a prior foray into crypto and it just did not take. So we'll see how it goes this time. And folks, if you want to learn more about me, visit my website, marketsandmayhem.com. If you want to check out Traderade, visit traderade.com. And to get up to 40% off Bookmap, visit traderade.com/bookmap and scroll down to the special offers. I want to thank you for tuning in to this week's episode of Back to the Futures with me, Markets and Mayhem. I'll be back next week at 9 a.m. Eastern. See you then.